What's going on, everybody? Live Fed meeting coverage coming up. This is a big one, of course, right after the election. We've been talking about it. This is actually one that we are waiting to find out what exactly is going to happen. And the crypto markets right now, they might know something, or maybe it's a little buy the rumor, sell the news. Regardless, crypto is in a great place for the next 4 years with Donald Trump at the helm. We know that because Bitcoin continues to set all-time highs yesterday and today. Actually, 2 days ago, yesterday and today, continuing to set new all-time highs. So, guys, welcome in. Welcome. Second live stream of the day. Hit the like button. Subscribe down below if you haven't already. Let's see who we got in the house here. We got Bees in the house. What's up, bro? All-time high after all-time high. Yeah. Exactly, Boca. Boca G is in here. Let's go, man. Let's go. Ambidextrous is in the house. What's up, bro? All right, let's take a look at the markets while we wait and see what's going on, right? This is the actual stream that we'll pull through here once we get off and rolling here. But let's take a look at the markets. My, oh my, man. Bitcoin is just scorching right now. Bitcoin is on absolute fire right now. I want to look at my Bitcoin holdings here. Hold on one sec. Let me pause for a minute here. Oh yeah, it looks pretty good. Today's return up another. Yeah. Things are looking good in Bitcoin land. And things are looking good in crypto, guys. How about Ethereum? Ethereum waking up, right? Waking up from the dead. Here we go. ETH pressing up against 2,900 right now. Continuing to look extremely bullish. We have not seen these type of numbers, guys, since you got to go back into August. We have not seen ETH this high since August. Hey, happy to hear that, man. Hey, Zach, loving XT Algo. Dude, that's awesome. Super pumped to hear that. That's good stuff. Glad you're loving it, bro. XT Algo, link down below, guys. If you're interested, check it out. It's my trading indicator that he's talking about. Super easy to use. Lets you know when to get in and out of trades. Big discount code, link down below. So glad you're using it, bro. Glad you're using it. I was just commenting on Ed Krasenstein's post, if you guys care to know. He said, uneducated people call education indoctrination. Told him I have a PhD and I call it indoctrination. But anyway, in other news, Ethereum's looking really good. What else do we got here? Nairo continuing to go up higher. What else do we got? Pepe, man. Pepe's on a nice run. Kronos trying to get back to 10 cents maybe. Cardano trying to get back to 40 cents. I'll take that. Ondo Finance looking really good too. We bought a bunch of Ondo at 63 cents not that long ago. Yeah, look, it dipped just right here. 3 days ago, we were down here below 60 cents. Now Ondo back up to 75. Love it. Love that V-shaped recovery there on Ondo. Man, that was a nice dip there. That was a great opportunity to buy the dip there on Ondo. We've come down here a couple different times. Look, this is basically our floor right here at 58 cents. I had it at 63 on the way back up. Actually used XT Algo. Looks like I got muted there for a second. I don't think XRP's done at all. I got to disagree with you here, Elliot. I think Pepe is primed, man. I mean, when you look at the alt chart here on Pepe, let's take a look real quick. If you take a look at the alt chart on Pepe, dude, this is setting up beautifully, to be honest with you. This is the daily. This is not done. I mean, look, the all-time high is just simply right here. I mean, it's not that far away. Really. I mean, not that far away at all. I think this chart's setting up beautifully. I think Pepe looks great right now. And here's the thing. Pepe's running because finally, Ethereum is running. That's what we've been talking about for a while. We need Ethereum to run if we want these large ERC20 cryptos to run. SHIB's lagging behind a little bit, only up 1%. I wouldn't be surprised if we see some carryover back into SHIB here. SHIB should be pumping a lot more based on where Ethereum is. And maybe it's just kind of a delayed reaction here. Who said XRP is done? Boca's going to take you out in the back alley. XRP hasn't begun its Valhalla run. I hope so, bro. My bags are packed. Crow with knife. Okay. All right, Elliot. I see you. How about Sui, guys? Can we talk about Sui for a minute? Man, Sui looks bullish, bro. Bullish. Just set all-time highs 17 hours ago, got up to 238. This is a big bet I'm taking on Sui. We started buying under $1, though, so we've got a really good position. I'm going to go out on a limb, I guess somewhat of a limb, and just tell you straight up, guys, I think Sui is the next Solana. I think Sui is the next Solana. I'm just going to tell you straight up. I think Sui is the next Solana. Straight up. There's always these new flashy layer ones, right? Like we know this. We know this because we watched what Solana did last cycle. We watched what Avalanche did last cycle. There are going to be some sexy layer ones that do just some unthinkable things. And Sui, I think, is one of them, man. Sui's on a tear. I mean, it has so many things that Solana had previous to its major run. And yes, they have meme coins too. Sui. I like Sui a lot. Got to move my Zen around. How many Zens did you guys do during the election? I did too many to count. What do you think about helium? Let me put myself right there. What do I think about helium? I've never owned it. XRP will never be done. No, I think it's going to be a slow grow, though, right? I think it's going to be one that it's not going to run necessarily until we have full clarity. XRP 5 to 10 minimum. I think going to $5 isn't out of the realm of possibility at all. That's helium makes me talk funny. Why? Dude, this damn mic, these are not cheap mics, these Shure mics, but the cord that goes into the back side continues to fall out all the time. 25 basis point cut. Okay, did we get the news? We're too busy talking about crypto. Here we go. Breaking. Federal Reserve cuts interest rates by 0.25%. Lower interest rates, global liquidity up equals Bitcoin up. Let's take a look at this. Let's take a look at this chart here. So there's Bitcoin having 4. Oh, man. We haven't even begun our upward trend after the halving, guys. Yeah, things are going to get fun, man. I think we're going to at least 120,000. That's my conservative estimate by some point 2025. Maybe higher. But yes, Federal Reserve cuts interest rates by 0.25%. That is coming in right now. And we've got the markets reacting. A little bit of buy the rumor, sell the news on Bitcoin. Imagine that. We get that a lot with the Fed interest rates. Let's see here. Let's zoom in. Let's zoom into the 5. We'll zoom into the 5 minute. Screw it. We'll go minute by minute. That's always fun. Look, you want to trade Bitcoin on the minute chart? You could do it using XT Algo, depending on what you want to do. There you go. Minute by minute. Boom. There was a little scalp opportunity right there. Look at this. 0.55% in 44 minutes. This is the minute chart, blow by blow here. Damn it, Zach. Love you, brother. We've been rocking since SHIB days, and I'm still waiting for my mod wrench. You know what? We could probably make that happen. I wish I could do it right from my software that I stream from, but I don't think I can. I think I gotta open the app up and actually give you a mod wrench. I'll give you one. That way you can help out. You can help out Boca. I do remember you too. You've always been around, man. I appreciate the support. That does mean a lot, man. Let me see. Where are you at? Add as moderator. There you go, bro. Boom. You're a moderator now. Send a comment now. You'll have a wrench like Boca G. Let's see. Volt in the house. What's up, Volt community? Would you mind looking at the chart for helium? Let's take a look. HNT, huh? Let's get out of the 1 minute. 1 day. Let's go to the 1 day. Let's look at the chart on helium. Huh. Doesn't look too bad. Lower lows, though. Lower lows on the daily. See right here, lower lows. I do not like that. This looks like kind of a dead cat bounce. But, I mean, the market's up, so that'll help you. But I don't like the lower lows here. I mean, if you would have got right in here when XT Algo triggered the momentum up, 58% move in the last 115 days. That's the last momentum up on the daily. So if you're more of a macro trader or like long-term trader, look at this. I mean, here's a 58% move you could have had using XT Algo on helium. Again, that's my trading indicator, xtalgo.com. Links down below in the description. If you're watching on X, you can find it in my link tree or in my profile. But it looks okay. I mean, I don't like those lower lows on the daily. RSI looks pretty good. Let's take a look at the technicals. See, even the technicals are showing sell, though. See, we're not above a lot of these moving averages. We are above the 200-day, which is good. Barely, though. So I would not be taking an entry just yet if I was on the sidelines on this one. That's me personally. I would just be watching it. I mean, this was your entry back here. Your entry was back here in July. That was your entry. We do have that clarity, Boca, but you know what I mean. I'm looking for full clarity from the institutional side, institutional sales of XRP. I see you, John. I see you. We were having first sips together. Oh, bro, you already know. You already know. I'm having a sip right now, an afternoon sip. A 2:09 p.m. in the afternoon sip right now. Wicked, what's up, bro? Let's go. Let's go. Got you, bro. Helium already had a bull run. Yeah, it looks like that, right? I mean, yeah, let's get those likes up 100%. 120 people watching here on YouTube. We got a bunch of other people watching on X. SHIB prediction from brother. I want to see us get to 100 billion. I want to see us get to $100 billion market cap. So that's breaking the zero. That's what I want to see happen. SHIB prediction from here. Okay. When you see the BlackRock ETF and launch of RLUSD, it's game on. I mean, that too. An ETF is big. The Ripple stablecoin is big. But so is clarity on the institutional sides, because that's where that's when institutions will invest. But we could have Donald Trump that, kicks out Gary Gensler. That would help us out too. Get some pro-crypto people in there. That would be nice. That'd be nice. Where y'all coming in from? Let me know in the chat where y'all are coming in from. Good afternoon, Medman. How you doing, bro? What would y'all say is a comfortable amount of XRP to carry? For me, I was just talking about this on the Crypto Breakfast Club. I only have about 2 to 3% in my overall portfolio allocated to XRP. Now, I trade XRP a little bit on margin, on leverage, like over on Margex. There's a link down below if you guys are interested in signing up, just because it's so easy to track. It goes up from 50 cents up to like 66, gets rejected. As long as this lawsuit's still going on, I don't see it like breaking out anytime soon. XRP will go to $5 with or without the lawsuit, in my opinion. Well, I mean, here's the thing. XRP still made a good move up to $2 last cycle. So I don't hate that prediction. I think it can get to 4 or 5 with or without the lawsuit being over. There's a chance it might not be over in 2025. Yep, 100%, John. Take your damn profits. Have a damn plan. When will SHIB pump? I'm surprised it's not pumping right now with Ethereum cooking. I mean, Ethereum is cooking right now, and SHIB's kind of just chilling. But Pepe's running. That's the second largest ERC20 crypto. Pepe's running. What's Caspa doing? Caspa's down a little bit. Athena making some moves, huh? So is MakerDAO. MakerDAO's been on a tear. Brett looking pretty good. It's another, crypto attached to Ethereum. I like Brett a lot, man. Just chilling right now. Down here at 77. People kind of forgot about it. It's not going anywhere. Just under $1 billion market cap. UK, Sean's in the house. What's up, bro? What base memes are going to explode? I mean, I gave you Brett. That's the only base meme I'm in. Oh, and I got some Toshi too. I still got some Toshi. I got Toshi and I got Brett. Not a ton of Toshi, but I got some. I'm actually down a little bit on that. But I do have Aerodrome, the biggest DEX on base. I own some Aerodrome finance. I do like that call. There's Gala. Quant's been quiet for a long time, hasn't it? Quant was a good play in the bear market, though. I think it'll come back. All right, what are people saying on X? Let's see. All right, so what's going on here? Virtual Bacon says FOMC, no balance sheet pivot, no QE yet. Hold your horses, altcoin season delayed for another 40 days. In support of its goals, the committee decided to lower the target range for the federal funds rate by 1/4 of percentage point to 4.5 to 4 3/4%. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data. There it is. Follow the data. The evolving outlook and the balance of risks. The committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities. The committee is strongly committed to supporting maximum employment and returning inflation to its 2% objective. I feel like I'm Jerome Powell himself speaking right now. I feel like that is like word for word, verbatim, like what he's going to say. Press conference is coming on live at 2:30, so we got 15 minutes. But does he have a script? I feel like he does. I feel like this is exactly what he would say. Might be right in the script. Tampa, Florida's in the house. What's up, Antonio? Gary's gone day one is what Trump said at crypto conference. Yeah, he's not in there yet, though. He can't make the moves yet. What's your opinions on LUNC? I liked it for a while. I was trading it for a while. I'm all the way out right now. I just think there's just other plays that I'm prioritizing. To make a trade on the minute chart, what's the typical fee encountered using XT Algo? There's no fee. Now you have to manually make the trade. You're using TradingView. So what XT Algo is doing is I walk you through how to use all this, but what you're doing, see this indicators button up here on TradingView and how I have XT Algo? So in order to get access to this script, you have to purchase XT Algo. And I walk you through how to use it. And then it just overlays on all your charts. So all this data, this momentum up, and the different colored candles, all of that auto-populates on your charts. And I walk you through how to use this. If you guys do decide to sign up, I give like a half-hour tutorial on all of this. So I'm not going to you're not going to buy the product and I'm going to leave you in the dark. It's going to be real easy to use once you watch my 20, 30-minute tutorial on how to get going and how to use it. Do you expect a big rise in Doge? I'm telling you what, I like Doge a lot, Ace. I like Doge a lot. I've been stacking too at 10 cents. Anytime below 10 cents, been loving it. And I think there's tons of upside, especially now with Trump at the helm. We know how Elon feels about it. Something big is coming with Doge. That's my opinion. Something big is coming with Doge. Cat on base is exploding. #1 cat meme on base. Okay. All right, Jay. When will X get their payment and crypto platform up and running? That's a good question. Who knows? Oh man, my mouse needs a new battery finally. I've never had to switch this thing out. Bandit on base launches tomorrow night at 6 Central on Uniswap, created by the one-leg bandit. Okay. Zach Powell. Yeah, exactly. I'm invested in VET, VeChain, ADA, Kronos, Dent, Link, ICP, XRP. You got a lot. I like it, bro. You think Gary will resign before Trump gets in to save the firing embarrassment? That's a good, yeah. I mean, we see that a lot, even with like corporations and stuff, right? Could be. I mean, I could see it happening. If you are not subscribed, I don't know what the hell you're doing. Make sure you hit the subscribe button. We're here every single day. So if you're not yet subscribed, again, I don't know what the hell it is you're doing. Make sure you subscribe. You're crazy not to. It's totally free. All it means is you're going to see my videos pop up more, and you get more alpha like this, and you get more live streams like this, and you get more content. So hit the subscribe button. What coins you like? Oh, man. We could sit here all day, bro. I'll give you a quick rundown. 65% of my portfolio is in Bitcoin. Another 15 to 17% is in Ethereum. Another 10% is in Solana. And then a bunch of other stuff. So I'm really heavily weighted at Bitcoin, Ethereum, and Sol. I got some Doge. I've got a big bag of Cardano. I've been waiting. Got some SHIB. Don't have any AVAX right now. I do think it's a good idea to maybe have some, though. I like Chainlink still. Don't have a ton, but enough where when it does start to run. Sui's a big position of mine. I got some Aptos. BitTensor Tau is one of my top AI plays. Caspa is a top 5 holding of mine. My top 5 holdings are Bitcoin, Ethereum, Solana, SUI, and Caspa. Again, my top 5 holdings: Bitcoin, Ethereum, Solana, SUI, and Caspa. Top 5 holdings. So I gave you some insights there. It also depends on what your overall portfolio looks like, right? So like, it's not a one size fits all approach. It's not like, hey, do it this way because that's the way that person does it. A lot of it depends on, are you still actively accumulating? What's your overall portfolio size? What's your goals with, taking profits here in this bull run? So it's not just as simple as, oh, so-and-so's doing this, so I'll do this too, right? You can't think of it like that. It's not a one-size-fits-all approach when it comes to building out a portfolio. But I gave you some game there. New all-time high again here on Bitcoin. Critical moments ahead of interest rate decision. Here's the latest data. Oh, we already got that. Let's see what other people are saying here. About 9 minutes away from JPAL. All right, here's the summary of the Fed decision. I like Kobayashi letter quite a bit. Fed cuts interest rates by 25 basis points in the second cut of 2024. Vote for 25 basis point rate cut was unanimous. Fed says risks to goals remain roughly in the balance. Labor market conditions have generally eased. Fed removes gaining confidence on inflation, moving to 2%. Fed will continue to reduce its balance sheet. We expect another 25 basis point rate cut in December. This was the definition of a down-the-middle Fed interest rate decision. It's clear the Fed is attentive to recently hot core inflation data. The Fed is navigating tons of uncertainty into 2025. But you know who doesn't care? Bitcoin. Bitcoin doesn't care. That's who really doesn't care. Bitcoin. Wow, look at this. California during the election, man, a lot more red there. Interesting. Huh. That's pretty shocking. The committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities. QT continues. Quantitative tightening. QT, if you guys are wondering. Hear all these people who say they're not having babies now for the next 4 years? Fluffy on ETH. Look at the county map of the election, Zach. All right, 6 minutes away from JPOW. JPOW. How many times is he going to say data? My man, that's his favorite word. We're going to follow the data. 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 What are memes doing? I aped into this thing earlier. I don't know what the hell it is. Some guy came in the Crypto Breakfast Club. I got in at like 55K market cap. All right. I put like $100 in. Hey, quick intel's up a little bit. Nice. Oh, they're breaking out a little bit. Very nice. What's Tide doing? Tide's up 15%. Nice. TARS AI. This is an interesting AI play. Backed by Solana Foundation. I think the AI narrative is going to heat up again, big time. Big time. Speaking of big time, where's big time at? Let's see. In the gaming sector, I like this one quite a bit. Big time still making some moves. Still way down from its all-time high. Big time is going to be a nice play, I think, in the gaming sector. I hold a bunch of Superverse too. Where are we at today? Up at 136. Starting to pop a little bit. We bought more at 120. Lock in on Solana. I like that. Is that a meme? Lock in. 105 mil market cap? Oh my gosh. Sending right now. Yeah, I'm not buying the top here, but good Lord. Hopefully you guys are making some money. Sheesh. When did this thing come out? March. Dude, that thing's nuts. Yeah, it did, bro. I know. And I missed it. Do I even want to look at the chart right now? This is it on Sol. Is this the one everybody's in on? Or is there one on ETH that's even crazier? This is one on ETH. Who knows? There's probably freaking dozens of them, right? A lot of liquidity pools too. The one on Sol, though, 6.44 mil. Big sell-off today, huh? $100 mil market cap. Peanut on Sol is the CTO, of course. So what's the one on ETH? What's the one that's at 100 mil? Is it this one? That's the one that comes up. Yeah, you always got a cabal and you got a CTO now. It's freaking nuts. You got to have a cabal one, you got to have a CTO one, and then you got to have a whatever. I mean, it's like you can never just have one token now. You got to have multiple tokens, one for the cabal, one for the CTO, one for the whatever. JPal should be coming on here shortly. Hear that? Too loud? Let me know. I never know if it's coming through too loud or not. Got to find the sweet spot on there. Wanted to get us hyped up for the JPal conference. All right, cool. Uh-oh. We've got movement. Can you guys hear this when I unmute? Let me know. There's nothing to hear right now, but the man of the hour, here he is. Let me know if you guys can hear him.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state and remains solid. Inflation has eased substantially from a peak of 7% to 2.1% as of September. We are committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the FOMC
all right, how about now? Hold on. Give me a minute.
In reducing the degree of policy restraint by lowering our policy interest rate by a 1/4 percentage point. We continue to be confident that with an appropriate recalibration of our policy stance, strength in the economy and the labor market can be maintained, with inflation moving sustainably down to 2%. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.8% in the third quarter, about the same pace as in the second quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has strengthened. In contrast, activity in the housing sector has been weak. Overall, improving supply conditions have supported the strong performance of the U.S. economy over the past year. In the labor market, conditions remain solid. Payroll job gains have slowed from earlier in the year, averaging 104,000 per month over the past 3 months. This figure would have been somewhat higher were it not for the effects of labor strikes and hurricanes on employment in October. Regarding the hurricanes, let me extend our sympathies to all the families, businesses, and communities who have been harmed by these devastating storms. The unemployment rate is notably higher than it was a year ago, but it has edged down over the past 3 months and remains low at 4.1% in October. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly over the past 2 years. Total PCE prices rose 2.1% over the 12 months ending in September, excluding the volatile food and energy categories. Core PCE prices rose 2.7%. Overall, inflation has moved much closer to our 2% longer run goal, but core inflation remains somewhat elevated. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we're attentive to the risks to both sides of our mandate. At today's meeting, the committee decided to lower the target range for the federal funds rate by a 1/4 percentage point to 4.5% to 4.75%. This further recalibration of our policy stance will help maintain the strength of the economy and the labor market and will continue to enable further progress on inflation as we move toward a more neutral stance over time. We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing policy restraint too slowly could unduly weaken economic activity and employment. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. We are not on any preset course. We will continue to make our decisions meeting by meeting. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains strong and inflation is not sustainably moving toward 2%, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly, or inflation were to fall more quickly than anticipated, we can move more quickly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
Thank you. Given the expectation that the election outcome will produce policies that would meaningfully impact the U.S. economy next year, how is the committee taking these proposals into account for upcoming decisions, including potentially the next one in December? And can you give us any more sense of how proactive or reactive the Fed is prepared to be to changes in economic policies with the next administration?
Sure. So let me say that in the near term, the election will have no effects on our policy decisions. As you know, many things affect the economy, and anyone who writes down forecasts in their job will tell you that the economy is quite difficult to forecast looking out past the very near term. Here, we don't know what the timing and substance of any policy changes will be. We therefore don't know what the effects on the economy would be, specifically whether and to what extent those policies would matter for the achievement of our goal variables, maximum employment and price stability. We don't guess, we don't speculate, and we don't assume. Now, just in principle, it's possible that any administration's policies or policies put in place by Congress could have economic effects that over time that would matter for our pursuit of our dual mandate goals. So we, along with countless other factors, forecasts of those economic effects would be included in our models of the economy and would be taken into account through that channel.
Nick.
Chair Powell, Nick Timrose from the Wall Street Journal. Roughly 1 year ago, when the 10-year Treasury was flirting with 5% and 30-year mortgage rates were near 8%, you noted how higher borrowing costs, if they were sustained, could weigh on economic activity. Given that you've said you believe policy is restrictive and the Fed is now dialing back that restriction, are the growth risks presented by higher U.S. Treasury yields today any different from those you identified 1 year ago when inflation was still meaningfully above your target?
So I would just say this: we've watched the run up in bond rates, and it's nowhere near where it was, of course, a year ago. I guess the long run rates are well below that level. So we're watching that. Things have been moving around, and we'll see where they settle. I think it's too early to really say where they settle. Ultimately, I'm sure we've all read these decompositions of what, and I certainly have, but it's not really our job to provide our specific decomposition. I will say, though, that it appears that the moves are not principally about higher inflation expectations. They're really about a sense of more likelihood of stronger growth and perhaps less in the way of downside risks. So that's what they're about. We do take financial conditions into account if they're persistent and if they're material. then we'll certainly take them into account in our policy. But I would say we're not at that stage right now. It's just something that we're watching. And again, these things don't really have mainly to do with Fed policy, but to do with other factors in the economy.
If I could follow up, is the September SEP, are those rate projections still valid? Do they still seem relevant given where we are now?
You know, you get halfway through the cycle between the last set and the next set. I wouldn't want to comment one way or the other. You know, let's talk about the data we've gotten since the last meeting. So in the main, the economic activity data have been stronger than expected. The NIPA revision was stronger. Certainly the September employment report was stronger. The October report, not stronger. Retail sales stronger. So overall, though, I think you take away a sense of some of the downside risks to economic activity having been diminished with the NIPA revisions in particular. And so overall feeling good about economic activity. So I think we would factor that in. At the same time, we got one inflation report, which it wasn't terrible, but it was a little higher than expected. So I think really the question is December, and you know, by December we'll have more data. I guess one more employment report, two more inflation reports, and lots of other data, and you know, we'll make a decision as we get to December.
Gina Smilik from the New York Times. Thanks for taking our questions, Chair Powell. When it comes to December, what will you be looking at specifically as you try to make that decision? And then as of the Fed's economic projections in September, you had written down 4 quarter-point interest rate cuts in 2025. Do you still think that those are likely? Is that sort of the baseline outlook at this point, or has that shifted? And if it shifted at all, can you give a little bit of detail as to why?
You know, we don't fill out an SEP, and I can't characterize one that wasn't filled out today. So I can't really speak for kind of exactly where the committee is. I will just say for December, we're going to be, again, at every meeting, we're going to be looking at the incoming data and how that affects the outlook. As you know, we're in the process of recalibrating from a fairly restrictive level at 5.33%. After today's move, we're down 75 basis points. And we're asking ourselves, is that where we need to be? You know that we're trying to steer between the risk of moving too quickly and perhaps undermining our progress on inflation, or moving too slowly and allowing the labor market to weaken too much. We're trying to be on a middle path where we can maintain the strength in the labor market while also enabling further progress on inflation. We think that's where we are, but that's the question we're going to be asking in September. And in other meetings. And again, I can't really update you on the committee's thinking because we don't fill out an SEP at this meeting.
Yeah, totally appreciate that. I guess when it comes to your own thinking, do you think that a full percentage point of rate cuts in 2025 is a reasonable outlook?
Again, we're going to wait and see how things come in December. I mean, it's just, I would put it this way. We're on a path to a more neutral stance. And that's very much what we're on. That has not changed at all since September. You know, we're just going to have to see where the data lead us. We have, you know, a whole 6 weeks of data to look at to make that decision in December. Obviously, I'm not ruling it out or in, but you know, I would say, you know, I would say that. You know, again, we didn't update the SEP, so I'm not going to characterize, you know, where the committee would be.
Howard.
Thanks, Howard Schneider with Reuters. I wondered if you could please elaborate, explain a little bit the 2 changes in the language of the statement here. In the first paragraph, when you say inflation has made progress, dropping the word further progress. And in the second paragraph, dropping the sentence that the committee had gained greater confidence that inflation was progressing towards its 2% goal. Is there any policy substance behind either of those changes in language? Is it meant to open the door to a December pause? Is it meant to communicate anything about the stickiness of core inflation in the last 3 months?
Not really, no. So let me tell you what we were thinking. So the test of gaining further confidence was our test for the first rate cut, right? And so we met that test in September, and therefore we take that test out. If you leave it in, then it's new forward guidance. It's brand new forward guidance. What do you mean by it? Are you requiring yet further? We have to say yes or no at every meeting whether we've made further progress. The point is we have gained confidence that we're on a sustainable path down to 2%. So that I would tell you is what that's really all about. It's not meant to send a signal. Neither of those is meant to send a further signal. And saying further progress, it becomes a test. We don't want to be. We don't think it's a good time to be doing a lot of forward guidance. There's a fair amount of uncertainty in that. In what I've said, the path that we're on, we do know where the destination is, but we don't know the right pace, and we don't know exactly where the destination is. So the point is to find the right pace and the right destination as we go. And I think there's a fair amount of uncertainty about that. And you don't want to tie yourself up with guidance. You want to be able to make sensible decisions as you go.
Steve Leisman, CNBC. Mr. Chairman, you talked about higher rates, perhaps from an expectation of higher growth. You didn't talk about it in terms of expectations of higher deficits. Is that something you think might be behind the recent rise in interest rates? And are rising deficits a concern to you?
So we don't comment on fiscal policy. And again, I don't have a lot more to say on what's driving bond yields. In terms of policy changes, though, let me give you a sense of how this works in the ordinary case. Let's say Congress is considering a rewrite of the tax laws. Doesn't matter what's in the content. So we would follow that. At a certain point, we'd think we see the outlines, so we'd start to model it. And then we'd wait, and then at a certain point, the staff would brief the FOMC and say, these are the likely effects. There's lots and lots of literature on the effects of tax policy changes on various parts of the economy. So we'd try to get smart on that, and then the law actually passes. And you'd start to you'd probably run an alternative simulation before that happens, just to keep people trying to understand it. Then when it actually passes, it goes into the model, along with a million other things. So, we have a very large economy. Many things are affecting it at any given time. And, a law change of some kind would go in there, but it would, it's a process that takes some time. Clearly, the legislative process takes a lot of time. And of course, the real question is not the effect of that law. It's all of the policy changes that are happening. What's the net effect? And, the overall effect on the economy at any given time. So I think that's a process that takes a lot of time and that we go through all the time with every administration, constantly. And this will be no different. But right now there's nothing to model right now. It's such an early stage. We don't know what the policies are, and once we know what they are, we won't have a sense of when they'll be implemented or all those sorts of things. So I think I would just say we're not doing that now, and all that will take time. And it will be very much regular order when we do that.
If I could just follow up on Nick's question, are the current rates something you feel like you need to lean against in that they go against the direction of policy by adding restriction to the economy, or do you just take them as a given and perhaps a signal that you should do less?
I just think the first question is how long will they be sustained? If you remember the 5% 10-year, people were drawing massively important conclusions, only to find 3 weeks later the 10-year was 50 basis points lower. So it's material changes in financial conditions that last, that are persistent, that really matter, and we don't know that about these. What we've seen so far, we're watching it, we're reading, we're doing the decompositions and reading others, but right now it's not a major factor in how we're thinking about things.
Chris.
Thank you, Chris Rugaber at Associated Press. You mentioned the positive economic data that we've seen since the September meeting, including the revisions to things like savings, higher GDP growth. We saw stock market jump yesterday. That's renewed some of the questions about why do many cuts at all in this with this backdrop.
So you're right. As I mentioned, and as you mentioned, the latest economic data have been strong, and that's, of course, a great thing and highly welcome. But, of course, our mandate is maximum employment and price stability, and we think that even with today's cut, policy is still restrictive. We understand it's not possible to say precisely how restrictive, but we feel that it is still restrictive. And if you look at our goal variables, the labor market has cooled a great deal from its overheated state of 2 years ago and is now essentially in balance. It is continuing to cool, albeit at a modest rate, and we don't need further cooling, we don't think, to achieve our inflation mandate. So that's the labor market. Inflation has moved down a great deal from its highs of 2 years ago, and we judged, as I mentioned, that it's on a sustainable path back to 2%. So the job's not done on inflation. But if you look at those two things, we judged in September that it was appropriate to begin to recalibrate our policy stance to reflect this progress, and today's decision is really another step in that process. Overall, as I mentioned, we believe that with an appropriate recalibration of our policy stance, we can maintain strength in the labor market even as our policy stance enables further progress toward our inflation goal.
Great. And just to follow up, what might cause you to pause rate cuts in December? What kind of economic data would lead you to that path? Thank you.
So we haven't, made any decision like that at all. But we're in the process, as I mentioned, of moving policy down, our stance down over time to more neutral level. And as a general matter, as we move ahead, we are prepared to adjust our assessments of the appropriate pace and destination as the outlook evolves. So, for example, if we were to see the labor market deteriorating, we'd be prepared to move more quickly. Alternatively, as we approach levels that are plausibly neutral or close to neutral, it may turn out to be appropriate to slow the pace at which we're dialing back restriction. Again, haven't made any decisions about that, but that's certainly a possibility. If you can think of it as similar to what we do with asset purchase, with asset runoff, with QT. So we reach a point where we slow the pace, much like an airplane reaching the airport slows down. And so we're thinking about it that way, but it's something that we're just beginning to think about.
Edward. Thanks, Chair Powell. So with the noise in the jobs reports that we've seen, and you look at the Fed's favorite inflation, PCE inflation, overall it's 2.1%, very close to the Fed's target, but core inflation is 2.7%, and it's been that way since July. So why doesn't this data give fuel to a rate pause for this meeting?
Well, so I think if you look at the 3 and 6 month, you're quoting the 12-month. So we look at all of them, right? But if you look at the 3 and 6 month core PCE, you'll see they're around 2.3%. So we look at all of them, and we look at 12 as well. But what it's telling us is that we really have made significant progress, and we expect there to be bumps. For example, the last 3 months of last year, the core PCE readings were very, very low, probably unsustainably low. So that's why forecasts generally see a couple of upticks toward the end of the year. On the other hand, the January reading certainly looks like an example of residual seasonality, so that we saw last year. So when that falls out of the 12-month calculation in February, we should see a thing down. So it'll literally be a bump up and then down. We understand that. Overall, you see the progress on inflation, and you also look at the economy and you say, what is the inflation story now? Where's it coming from? So I point to a couple of things. One is the non-housing services and goods, which together make up 80% of the core PCE index, are back to the levels they were at the last time we had sustained 2% inflation, which happens to be in the early 2000s for a period of 5, 6, 7 years. So they're back to that level. What's not is housing services. So let's talk about housing services. Housing services is higher. What's going on there is, market rents, newly signed leases are experiencing very low inflation. And what's happening is older, leases that are turning over are taking several years to catch up to where market leases are, market rent leases are. So that's just a catch-up problem. It's not really reflecting current inflationary pressures. It's reflecting past inflationary pressures. So that's one thing. The other thing is I'd say look at the labor market, not a source of inflationary pressures. Where's it coming from? It's not a very tight economy. What is the story about inflation? You see that catch-up inflation also in insurance and several other areas. So you're seeing we're not declaring victory, obviously, but we feel like the story is very consistent with inflation continuing to come down on a bumpy path over the next couple of years and settling around 2%. That story is intact, and it won't be one or two really good data months or bad data months aren't going to really change the pattern at this point now that we're this far into the process.
So are you quickly trying to get to that neutral rate that you see, or do you foresee that you have some time to get there?
Nothing in the economic data suggests that the committee has any need to be in a hurry to get there. We are seeing strong economic activity. We are seeing ongoing strength in the labor market. We're watching that carefully, but we do see maintaining strength there. And so we think that the right way to find neutral, if you will, is carefully, patiently. Again, that's not meant to have a specific meaning, other than to the extent the economy remains strong, we have the ability to take advantage of that as we try to navigate that middle path between the two risks.
Craig.
Hi, Chair Powell. Craig Torres from Bloomberg. Two questions today. Did you learn anything about what Americans think about the economy from the election results? First question. Second question. I want to talk about some labor market indicators, and I do so with great respect for your attentiveness to the maximum employment side of the mandate, Chair Powell. So the unemployment rate has been at 4% or higher for 6 months. One of the broadest measures of unemployment is up about 0.5 point from a year ago. Compensation gains are sliding back. The quits rate, a signal of labor market dynamism, has been heading down to that bad neighborhood of the 20 teens. So you have put a marker at Jackson Hole saying any further cooling is unwelcome. It is cooling generally a little bit further. So at what point do we reach what you would describe as a shortfall from maximum employment? Thank you.
Sure. So on your first question, I'm not going to talk about anything that relates directly or indirectly to the election. On the second one, this is the great question, and it's the one we think about all the time. So I'll just say a couple things. There's nothing really surprising here. What we know is that the unemployment rate is low. We also know that it's moved up significantly from a year or so ago. So we've seen a big change upward in unemployment. Sometimes that has meant bad things. So far, it doesn't appear to be. It appears that I wouldn't say that the labor market has fully stabilized, because I do think it's continuing to very gradually cool, but it seems to be in a good place, and our policy, of course, is designed to keep it in that good place, to maintain the strength in the labor market while also enabling further progress on inflation. You mentioned a bunch of indicators, and you're right. The openings to unemployment rate is back to a normal level. I would characterize it more broadly as normalizing. You mentioned wages. Wages are still running just a bit above where they would need to be consistent with 2% inflation, unless productivity is going to remain at this high level. If we see productivity, more sustainably at these high levels, then that would sustain higher wage gains. So I would say, in fact, you can say it the other way, that wage increases are now consistent with 2% inflation given current productivity readings. But of course, the lore on productivity readings is whenever you see high readings, you should assume they're going to revert pretty quickly to the longer-term trend. That has always been the case for 50 years. But it may be that we're now 5 years. If you look at the NIPA revisions that came out a month ago, we're 5 years into a nice set of productivity readings, which are sustained and very healthy. But overall, it's a good labor market. We could talk about 20 different data series. We'll be looking at all of them, of course. We don't want the labor market to soften much from here. We don't think we need that to happen to get inflation back to 2%.
Victoria.
Hi, Victoria Guido with Politico. Some of the president-elect's advisors have suggested that you should resign. If he asked you to leave, would you go?
No.
Can you follow up on, do you think that legally you're not required to leave?
No.
Mike?
Michael McKee from Bloomberg Radio and Television. You talk a lot about what the data are telling you and how you are dependent on the data, but in terms of forward-looking assessments of the economy, what are you hearing from CEOs or other officials around the country? What did you hear today from the regional bank presidents about what companies and consumers think about where the economy is going from here rather than looking backwards? And does that match up with what your forecasts have been and what you think the appropriate policy path should be?
So it's hard to characterize a really interesting set of discussions we had, and of course you'll see them in the minutes in 3 weeks. But I would say this: I think the comments from our Reserve Bank colleagues and from the CEOs that they talk to are pretty constructive on the economy right now. Pretty constructive, feeling that the labor market is back to normal, to the point where it's no longer that much a discussion topic in their worlds, whereas 2 years ago it was all they were talking about. So they feel like the labor market's in balance. People feel good about where the economy is. Demand is obviously pretty strong, and you're seeing 2.8% growth in the third quarter estimated. Maybe the year's 2.5%. This is a strong economy. It's actually remarkable how well the U.S. economy has been performing with strong growth, a strong labor market, inflation coming down. We're really performing better than any of our global peers, and I think that is reflected in what you hear from what I hear people hear from CEOs. I don't get to talk to a lot of CEOs in my job, but I hear what others summarize from those, and of course I hear the Reserve Bank presidents do a lot of that, and it's pretty constructive overall. Now, that's not to say there are areas of caution and things like that, but ultimately, overall, pretty positive.
Well, to follow up the areas of caution, if there were black clouds on the horizon that you identified as something you're watching, what would they be?
I think it's things like clearly geopolitical risks around the world are elevated, and just as clearly they've had relatively little effect on the U.S. economy. Now, that can change through the price of oil or otherwise, but people talk about those as something that's on the horizon all the time. But ultimately, if you look at the U.S. economy, its performance has been very good, and that's what we hear from business people, and expectation that will continue. If anything, people feel next year. I've heard this from several people that next year could even be stronger than this year.
Andrew. Hi, it's Andrew Ackerman with the Washington Post. I just wanted to follow up on the discussion earlier on fiscal policy. Your predecessors, Greenspan and Volcker, spoke up loudly when they thought large budget deficits endangered economic or financial stability. Will you do that too? And right now we're in a period of full employment. We have large budget deficits and debt at historic highs that are rising. Is that something you'd speak out against?
So, I have said many times, no more, no less than what the predecessors you mentioned have said. And what that is that the U.S. federal government's fiscal policy is on an unsustainable path. The level of our debt relative to the economy is not unsustainable. The path is unsustainable. And we see that in, you've got a very large deficit you're at full employment, and that's expected to continue. So it's important that we, that to be dealt with. It is ultimately a threat to the economy. Now, I can say that. I don't have oversight. We don't have oversight over fiscal policy. I've said it on many occasions, just said it again.
Okay, thank you. I guess the other question is, to follow up on Victoria's question, do you believe that the president has the power to fire or demote you, and has the Fed determined the legality of a president demoting at will any of the other governors with leadership positions?
Not permitted under the law.
Not what?
Not permitted under the law.
Thank you.
Courtney. Courtney Brown from Axios. In response to Howard's question, you said it wasn't an ideal time to give forward guidance because of the economic uncertainties. Can you lay out what some of those uncertainties are and whether or not it includes some of the proposals that the president-elect has put out on the campaign trail? Tariffs, for instance?
No, I was not referring to the new administration's policies at all, nor will I today. What I'm just saying is, as we look ahead, we know, as I mentioned this in my statement, that the risks are two-sided. I guess I should start by saying that we think that the economy and we think our policy are both in a very good place, And but as you look forward, you say, what are the risks? And one risk is that we would move too quickly and find ourselves having moved too quickly, and inflation comes back, and we lost our chance to get inflation back to 2%. So we have to avoid that risk, and to avoid that risk, that means you want to move carefully. The other risk is that we move too slowly, and that we allow the labor market to weaken too much and do unnecessary damage to the labor market and to people's working lives. That says don't get behind the curve. So these two things are the two risks that we have to manage, and so we're in the middle there. We try to be in the middle and deal with manage both of those. Again, the idea is to support the strength we have in the labor market and in the economy, but also with somewhat less restrictive but still restrictive policy, enable further progress toward our 2% inflation goal. This is a thing where meeting by meeting we're going to be making our assessment of what the right path is. It's not as important. The precise timing of these things is not as important as the overall arc of them. And the arc of them is to move from where we are now to a sense of a more neutral policy. We don't know exactly where that is. We only know it by its works. We're pretty sure it's below where we are now. But as we move further, there will be more uncertainty about where that is, and we're going to move carefully as this goes on, so that we can increase the chances that we will get it right.
Simon.
Thank you, Chair Powell. Simon Rabinovich with The Economist. I know you don't want to share your decomposition of bond yields, but if you look at the break-evens, it is clear that longer-term inflation expectations do seem to have risen up at about 2.5%, for example, on the 5-year. That's up half a point from when you cut in September. Do you have any concern at all that longer-term inflation expectations are de-anchoring, or put another way, are anchoring at a slightly higher level? Thanks.
So we would be concerned if we thought we saw longer-term inflation expectations anchoring at a higher level. That's not what we're seeing. We're still seeing, between surveys and market readings, broadly consistent with, I looked at the 5-year earlier today, and it's probably moved, but it's kind of right where it's been, and also it's pretty close to consistent with 2% PCE inflation. So that's one that's been a traditional one that we look at a lot. But overall, expectations seem to be, and really have throughout this, in a place that's consistent with 2% inflation. But you're right to say we watch that very carefully, and we will not allow inflation expectations to drift upward. But that's really why we reacted so sharply back in 2022, was to avoid that.
Kelly.
Hi, Chair Powell. Kelly O'Grady, CBS News. We just talked about what you've heard from business leaders on the economy, but many average Americans are still not feeling the strength of the economy in their wallets. So what's your message to them on when they might expect relief?
So you're right that we say the economy is performing well, and it is, but we also know that people are still feeling the effects of high prices, for example. And the world went through a global inflation shock, and inflation went up everywhere, and it stays with you because the price level doesn't come back down. So what that takes is, it takes some years of real wage gains for people to feel better. And that's what we're trying to create, and I think we're well on the road to creating that. Inflation has come way down, the economy is still strong here, wages are moving up, but at a sustainable level. So it's just, I think what needs to happen is happening, and for the most part has happened. But it'll be some time before people, regain their confidence and feel that. And we don't tell people how to feel about the economy. We completely respect what they're feeling. Those feelings are true. They're accurate. We don't question them. We respect them.
And just a quick follow-up, President-elect Trump has been critical of your performance. Any concern about his influence on the Fed's independence?
I'm not going to get into any of the political things here today, but thank you.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. What is your plan if we start to see stagflation?
Well, so that's the whole plan is not to have stagflation, so we don't have to deal with it. So that is actually our plan. It's of course a very difficult thing because anything you do with interest rates will hurt one side or the other, either the inflation mandate or the employment mandate. I would just say that we've been able to see inflation come down a whole lot, much closer to our goal, without the kind of sharp increase in unemployment that has often accompanied programs of disinflation. So, knock on wood, we've gotten this far without seeing a real weakening in the labor market, and we believe we can complete the inflation task while also keeping the labor market strong, and that, of course, is exactly what we're trying to do.
Can you rule out an interest rate hike next year?
No, I wouldn't rule anything out or in that far away, but that's certainly not our plan. I mean, our baseline expectation is that we'll continue to move gradually down towards neutral, that the economy will continue to grow at a healthy clip, and that the labor market will remain strong. If you look at our that will not change from the September SEP. That is our baseline forecast, and short of some exogenous event, that will continue to be our forecast for the foreseeable future. So, but ultimately, we're not in a world where we can afford to rule things out a full year in advance. There's just too much uncertainty in what we do.
Let's go to Jean for the last question.
Hi, Chair Powell. Jean Young with MNI Market News. I wanted to go back to a comment that you had made about Americans being quite unhappy about the cumulative price level rises over the past few years, even though now inflation is back on a path to 2%. Would it be appropriate for the Fed to undershoot for a while on its inflation goal under the average inflation targeting regime so people have a chance to catch up?
No, that's not the way our framework works. We're aiming for inflation at 2%. We did not think it would be appropriate to deliberately undershoot. And part of the problem there is that low inflation can be a problem too, in a way. But that's not part of our framework, and it's not something we're going to be looking at in our framework review. Thank you very much.
All right, that's it. That's Jay Powell coming at you today. What I heard was this, guys, real quick. We'll do a quick wrap up, and then we'll get up on out of here. Bitcoin is pumping right now, by the way, setting new all-time highs, basically. Again, I think it literally just set a new all-time high again just now. Make sure of that. Yeah, about an hour ago, 76,726. I think we were just wicking up there, 76,709. Yeah, so I think that's a new all-time high, right? It's really close. Maybe not just yet, but literally we're working on it right now on the 5-minute candle. So Bitcoin's liking what Jay Powell said. I'll tell you guys this. It looks as if this could go 50-50 in terms of another, basis point move, another 25 basis point move in our last meeting of the year. But based on how he said it, we could have a pause too. I mean, I think no matter what, here's my takeaway. Regardless of what anybody really knows or thinks, and I don't know much when it comes to the Fed, I feel like it's been a decent, maybe even better than decent job done by Jay Powell. We're in a situation where, like he said, we're still seeing high grocery prices, but again, it's a lagging indicator. Over time, these prices should come down. And the biggest thing is this. We're getting ready for 4 years of a president who's crypto-friendly, 4 years of a president who had the economy in a good place last time he was here. So I think we're in a really good spot. And Bitcoin's liking it. There was no curveballs thrown out there by J Powell today, which you love to see that. Rest of the market looking pretty good too, guys. As Ethereum's climbing up close to 2,900, love to see it. We got altcoins running. Man, it's a great time. It's a great time in crypto. Over 2.5 trillion, by the way, global market cap of crypto as well. Guys, thanks so much for watching. If you're not yet subscribed to the channel, make sure you do so. If you're over on X, give me a follow. Even if you're not following me there yet, you can find the link down below in the description. And last, final reminder, if you want a trading indicator that works, going to help you navigate these crypto waters, XT Algo, link down below. Guys, thanks so much for hanging out with me. Appreciate it. We'll see you guys in the next video or live stream, whenever that is. You just have to subscribe so you know. We'll see you.